Ways and Means, here we are, April 23rd, Thursday, 2:30. We're picking back up S327. We are going to spend some time with Ellen on the CPACE language, and we have two witnesses about the CPACE language. And then Rick and Cameron are working on some amendments that we will review when they're ready about veggie and pennies. This is many arenas in this bill, and I'm glad to have you here, Ellen, to tell us about CPACE.
Thanks, Ellen Tchaikovsky, Office of Legislative Counsel. So did you already walk through the language?
But we don't really quite understand, and maybe you could give some more words.
Okay, did you want to put the language up on the screen?
That seems good.
Okay, so S327 does have the CPACE language in it. Commercial property assessed clean energy. And this language started in S138 in the Senate and then went over to House Energy, and now it went to economic commerce and economic development, and now you're here with it. So it just got added to this bill. Residential PACE or regular PACE has existed in Vermont since around 2010. There has been very little uptake in that program. And that program was established in 24 VSA Chapter 87, Subchapter 2. CPACE is being added as a new Subchapter 3 because it is very different than how regular PACE has worked in the state or not worked in the state. And so CPACE is very different than residential PACE. And so the municipality is involved because they first vote to establish whether or not they want to allow people within their town to use this financing program. If they vote to become a CPACE district, then the mechanism of a special assessment is activated, and private lenders can loan to private commercial property owners funds to do the projects under this law that fall under the categories of renewable energy, energy efficiency, clean energy, and water conservation and resilience projects. That loan is tied to the property. It is secured by a lien on the property. It remains with the property as opposed to the borrower. And this allows private financiers to have lower rates and longer payback periods.
And could it be for a property that they don't own?
Long-term tenant,
Thank
in
you.
other words.
Yes.
Oh, no, I believe it is just to property owners.
Okay.
Um,
The debt stays with the property when the property is sold.
yes. This is a lien that takes priority over other mortgages that are already on the property. And so this language includes a provision that requires consent of the other existing lenders on a property to consent to allowing the CPACE loan to be a priority loan.
But is it ahead of debts to the state or behind debts to the state?
I believe just, it is only subordinate to the municipal property tax lien.
Does the municipal property tax lien, education property tax lien?
I'm not sure I know the answer. Can you say that again?
Does the municipal property tax that it is subordinate to include the education property tax?
I do not know the answer to that. I can get back to you. I know almost nothing about property taxes generally. This is a little bit of an unusual bill for me.
Okay, thanks. That would be good to know that soon. Okay, thanks.
I think it's yes.
I think so too. I just want to be sure.
And if the tax is the assurance, the municipality says if they default and the property say partially developed, then the loss goes to the municipality. Right?
No. if there is a foreclosure or default,
Mhm.
only the past due amount that is still owed is what is owed at that time. The rest of the payments do not become due at that time. Only the back payments are owed. And so, if a new property owner took ownership, they would just have to clear the past, and they would resume. And so the large distinction with this case is that the municipality is not under any liability for that situation and will not have to take on any of that debt.
Sorry, one second, Saoirse, it seemed like something weird just happened with the camera. Are things okay? Okay, cool.
So. I have a question.
Yes.
In going back to Charlie's question, wouldn't they also need the school district to sign off on this in addition to the town? Because the district is, if it does affect education funds.
So my understanding is that the municipality is still responsible for collecting that property, that tax. If it is subordinate to the tax, then the taxes always gets paid.
Yeah, so the assessment for the loan repayment here is just added as an addition to the tax bill that a property owner would get. And so the town's general tax authority is not changing. This would just be an addition to it.
Mostly the municipality is taking responsibility for essentially paperwork.
Yes.
More than anything else.
Yes. And even under this structure, they could hire a program administrator to do that for them.
Is there someone in this structure who is going to be responsible at the state level for helping municipalities navigate this if they want to navigate this?
Not specifically.
Okay.
There is authority in the later chapter for program administrators. Originally, there was a proposal that the Department of Financial Regulation would help identify entities that would be suited to be a program administrator. However, that's been taken out and really is just focused on the municipality is allowed to hire someone themselves to do the program administration, or they don't have to.
Okay. Thanks. Yeah.
Yes, Madam Chair, I think your answer to Rep. Holcomb's question is consistent with what I understand about who ultimately has to pay, which is that the municipality, the town has to pay taxes, not the school district. I'm not sure exactly where we find that, but there was a question a year or so ago about who pays the tax at the end of the day, the town or the town collects the taxes and the town has to remit to the state or the education fund or whatever it is. And I haven't got the right place, the right language, but I'm pretty sure that that's the case. The town is responsible.
What else can you tell us about this?
I think that broadly covers it.
Okay. Does anyone have more detailed questions about the language that have come up from yesterday? Representative Brannigan, I remember. We also have a CPACE expert advocate, someone from the CPACE Association Alliance coming to talk to us at 3:15. So some of those questions might be three.
I was only wondering, how is this different than the regular PACE or consumer PACE or whatever?
So primarily the use of program administrators is one of the big differences. And so under the original PACE, the municipality was deeply ingrained and enmeshed in this process. They were the ones that were potentially in debt or had liability. And so they were taking on debt themselves potentially to fund these projects. And then because of that, there also was a state reserve fund to help municipalities become whole if something happened and there was a foreclosure and the towns couldn't reclaim any payments. This system is a lot more private entity based, where the private loan is made to the property owner and the municipality is primarily just serving as a pass-through to collect the funds because of the existence of the lien on the property. And so I do think in the original program, there was a lot more risk for the towns themselves. Whereas here, it is clearly saying that the municipality is not subject to liability for either any of the projects failing or any of the borrowers defaulting.
That makes perfect sense. I see most towns being too small and thinking, who's gonna manage this? Yeah, do they need to pick up the debt?
Any other questions for Ellen? Okay, I think what we're gonna do is we're gonna, pause the feed, mute the room. Ellen, thank you. Delia's gonna play with the camera. We're gonna hang out here. And then our next witness and or our amendment will arrive. Great. So we are still here in Ways and Means. Our camera is fixed. We are still working on S327. Michael Yaki just joined us, who's senior counsel at Petros Pace Finance. And hello, thank you for joining us.
Thank you for inviting me.
We've heard two walkthroughs on the CPACE language, but would just sort of love to hear from you about why anyone would want to do this.
Okay, so thank you very much. Michael Yaki here from Petros Pace Finance. My specialty is writing these laws and creating these programs, and it stems from my own years in public service and having an affinity for getting this stuff done. So commercial pace. Commercial pace is essentially an innovative way of providing private financing to private property owners to fulfill public policy objectives enacted by the state regarding clean energy, renewable energy, energy efficiency, water conservation, and now in many states, in fact, the majority of states, resilience. It is innovative in that it is a form of public-private partnership with local governments that utilizes the property tax power of local governments for the assessment power, which is pretty much the same thing in many ways. Partner with private capital so that you kind of have the benefits of kind of both worlds in terms of, because it is levied as part of the assessment taxing power of a local government. The lien and the assessment have the character of local government power, which means that in capital markets, it's seen very much like a bond, in that you can do it for a longer term. It's at a lower rate. That becomes attractive to a property owner. But how CPACE is different than a bond is that it is fully funded from private capital and is not guaranteed nor backed by the full faith and credit of the local government. So all risk is on the private capital provider in making this financing to a property owner. It is a system that started in California about 14 years ago. It is now in 38 other states. Vermont would be number 39, and the District of Columbia. It is pretty much all your neighbors have enacted CPACE statutes. New Hampshire was enacted last year. We look around Maine, Massachusetts, New York, Pennsylvania, Rhode Island, Delaware, all of them, Connecticut, all of them have active and very successful CPACE programs. Again, like I said, how it works is that a property owner and a private capital provider, it can be a company, it can be a bank, a credit union, work together to sort of figure out whether or not a property, whether it needs a retrofit, repair, if they're going to do a gut rehab, or if they're going to build something new, whether or not CPACE fits within the kind of financing that they're looking for. I mean, it's very rarely just pure CPACE financing, because there are lots of other things that people do to upgrade their properties. They have more interiors, they have exterior finishes, things like that. But what it does do is it creates an incentive to do the things you would like them to do, which is upgrade their property to the new code or better. Harden their property against against storms or flooding or snow. There's actually a snow load provision in the Alaska program that that then incentivizes a property owner to try and do these things, which is good for the public policy that you're enacting by doing the statute. So what you do by enacting this statute is you're giving this power to local governments. They don't innately have the power to just do an assessment on private property for that isn't backed by a bond. You have to do this for them, and then the local government can then decide voluntarily whether or not it wants to offer this financing to its property owners. So that's basically what this statute does. The statute authorizes local governments to utilize this power if they so choose and create a program within their jurisdiction to offer it to willing, able, and voluntarily consenting property owners. Interesting thing about this is that when I say it's a very different kind of financing, it's very different in many ways. One of which is the fact that the governmental lien, which I talked about. The second, I think that one of the signature marks of this is that in order for the assessment and the lien to be put on the property, one of the qualifying factors is that any other secured lender on the property, or who is going to be a secured lender on the property because they are financing it with CPACE as well. So another bank, another credit union, you say they're all going together to build a new building. CPACE is part of that. The bank is part of that. The credit unions are part of that. Equity. Any other person who has a lien, or with at the same time as the CPACE financing is going to put a lien on the property, has to consent. They have to say, we will allow you to utilize CPACE financing and put an assessment on this property in the amount that you're looking for in order to make it happen. Why that's important is because what it means is that a property gets underwritten 3 times. First time is by any other lender who is already on the property or is going to be on the property. They're looking at it to see whether or not this is going to make sense to them. Then it's underwritten by us to see whether or not it makes sense for us, the capital provider, to do it. Then it's underwritten a 3rd time, again by the lender, who now has to look at it from the standpoint of their interest, our interest, and whether or not our interest is going to jeopardize their interest. So what that means is that it's very tight underwriting, very strong underwriting. We have much lower, almost non-existent default rates in the country and around the nation. And like I said, what it does is it provides these benefits to local governments. What we see is that there was sort of an unintended consequence of CPACE, which was economic development. It's been a very strong part of the economic development programs of many local governments because of the fact that a lot of projects that were looking for that other bit of financing to make it happen, having CPACE involved because of the lower interest and the longer time period, which means it has a much lower impact on cash flow, enables them to finally make these projects pencil out. So I think that's one of the reasons why the Commerce Committee wanted to put it in the Economic Development Bill, because it has that kind of power to help local governments do it. Anyway, that's sort of the 30,000-foot version of CPACE. I can go into any more details that you want, but again, 38 other states have it, thousands of jurisdictions across the country. All your neighbors have enacted it as well. We know that there is interest in Vermont. We've been hearing from property owners for years about it, and we'd love to see the legislature enacted. And let me answer any questions that you may have, because this is like drinking from a fire hose.
Help me understand, thank you for all of that. Can you help me understand why it's considered a more secure loan than a regular commercial loan? given that the municipality is not, it is not the full faith and credit of the municipality. They're really
Sure.
just serving as a flow.
Sure. And that's sort of the magic of this. The reason, because it is considered to be a governmental assessment, it has two unique features about it that a property tax has. One, it stays on the property until it's paid off. Unlike in a mortgage foreclosure, if the first mortgagor forecloses, everyone, the second or third, get wiped out. CPACE doesn't get wiped out because it's a governmental assessment on the property. That makes it very secure. Because of that, the capital markets look at this very favorably, and they will give it the kind of rating that enables us to offer lower cost financing over time. The second reason is because it, as I said, it stays on the property until it's paid. It transfers via ownership unless a new owner decides they want to pay it off. That has an unintended consequence to the property, or an intended consequence to the property owner, which is that instead of having to pay, if something over 10 years, it can be paid over 25 or a maximum of 30 years under this legislation. What it also does is that because it's on the property and not on the property owner, that's also the other kind of security that is different than in a mortgage. In a mortgage, if you don't pay your home mortgage, you get a letter from the bank saying you need to pay this, or all of it becomes due and you are personally responsible for this. Here, that doesn't happen. It is secured on the land itself. Only those payments which have not been paid are ever at risk of foreclosure. So it's not like if we put $1 million on a property, but the annual payment was like $50,000. If someone doesn't pay, all that's at risk is at $50,000, not the entire amount. And again, because the rest is secured and stays on the property. That's why it's a more secure form of financing than a mortgage, because in a mortgage, you get what you can at a sale, and then whatever is left, you got to eat. If you put a mortgage on a property for $1 million, they don't pay, you foreclose, and you only get $800,000 in the sale, the $200,000 evaporates. In CPACE, that doesn't happen. It stays on the property until it's paid.
Thank you, that's helpful. Representative Kendall?
Yeah, Mark, just a couple of questions. Because the perceived risk is lower, what is the interest rate on CPACE loans versus a commercially available mortgage?
It all depends. Usually, it depends on the kind of market that you're in. Usually and CPACE is constantly changing. Sometimes but it is usually a little bit above a commercial mortgage, because that's
Really?
that they're always going to be lower because they just have the ability to do that. But in terms of the other forms of financing, equity, seconds, mezzanine financing, lines of credit, it's always going to be much lower than that. And again, because it's spread out over a longer period of time, the cash flow implications are a lot different. It's not like you could borrow $1 million at 2%, but it might be due in 5 years. If you borrow $1 million from CPACE, it might be due in 25. And your ability to stabilize your property, recover your costs, ensure that your operations get up and running for whatever it is you're trying to do, and to improve your property or build a new one, that has a big impact on how people calculate what their risk is and what their cash impact is going to be.
Okay, and the only other question I have for you is in terms of in other states where this works, Is it just one-off in different communities, or is there a portfolio in any one community? I mean, how are projects generally spaced out throughout a territory or out of state?
It's I would say it's not quite random. You just you just don't know. CPACE is right now still in its infancy, even though its growth rate has been like this and now it's like that. And it's because people are starting to understand how it works. What you will find is that probably in the first few years, in any given community, you'll probably get a handful of projects. But as word of mouth gets out, you start to see that accelerate. In New York City, for example, well, they have other issues that they have to deal with their program. But after being dormant for like a few years, all of a sudden the projects are just starting to roll out. You see that in some of the most interesting locations. We've seen in terms of communities and states that punch way above their weight. Ohio is like has a third highest number of CPACE financings in the entire country. In terms of the last year, um, Idaho has some of the fastest growth anyone's ever seen, and it's just a fact. It's a factor of education, learning, and quite frankly, repetition. When people see someone else doing it, they find out about it, they learn more, things happen. But it would be it would be nice if it were as ubiquitous as a first mortgage or even a second. But because of the fact that it is a lot of information to digest, because we require the consent of every other lender on the property, it's something that is still, I would say, in its infancy, but it is growing. And one of the things that's important about it is that part of the reason that it has grown and expanded in terms of jurisdictions and states is because legislators such as yourselves are getting calls from their constituents who may be a developer, have a development in another state, or friends or relatives in another state, and get calls and say, "Would you please do this because we'd like to see this option for our properties in Vermont."
Thank you. Yeah, Representative Holcomb.
Something we haven't talked about is from a tax accounting perspective, what are the impacts of treating this financing as a tax assessment as opposed to a loan? And I'm from the perspective of the business, but I'm also just curious if it has any impact on state revenues.
Sure. First of all, there is no impact on state revenue because this doesn't take money away from or impact your credit or require you to put up any guarantees if the property owner doesn't repay. That's number one, and that's in the legislation as it stands right now, and in fact is in every state legislation that there is. Secondly, in terms of the property owner, that's a very interesting and smart question that you raised because it is a tax, because the full amount is never at risk of acceleration. It is treated very differently in terms of the loan to value ratio or the debt service ratio of any books, or how they do their accounting value on the books. The whole thing is never booked because the whole thing is never ever going to become due. It is a long-term debt, but in terms of short-term consequences or threats or asset or debt evaluation, it's not evaluated on the entirety because of the fact that it only is billed on an annual basis during the entire term that's been set. But it's one of the reasons why people like it. But that's a good question.
Any other questions? Yeah, Representative Brannigan.
So, I thought that this loan was only for clean energy products. Solar, wind. In fact, I just saw it here in the bill. But that's not true. It's for beyond clean energy.
It is essentially, when you think about the panoply of measures that are needed to deal with climate change, it started as a form of it started 12 years ago. as a way to help finance solar expansion. That is absolutely true. But what has happened is that legislators have seen this as a tool that they can use to sort of help deal with the issues of climate change. So in energy efficiency, water conservation, hardening your property against the consequences of climate change, whether it's the fact that it gets hotter or it's wetter or windier, depending on where you live. In places like the Atlantic seaboard, sea level rise is a big thing. In my home state of California, it's used for seismic as well. These are all things that are hard to get just conventional financing for on their own if you're just trying to retrofit a property. It's one of those things where you just can't go, if you can't afford, a lot of times there isn't that kind of financing available from conventional financial institutions. If you say, I'd like to take my heating and cooling system from an efficiency of like 16, that's one of the ratings, to like an 18. They're like, well, why can't you go down to Home Depot or something like that? And that's pretty much how this was created, was because that gap in financing that was available commercially. So yes, it did start off as clean energy, but legislatures have seen fit to expand it to address other public policy needs associated with climate change. Pennsylvania even has indoor air quality, which was a consequence of it being enacted during COVID.
Okay, thank you. Yeah, Representative Holcomb.
I'm still trying to understand how a company would book this. If this is a tax assessment, how would they carry this on a balance sheet?
They would, on the balance sheet, it would be seen as and I'm not an expert in this, would probably why I became a lawyer. But what I've been told, what I know is that it's not booked as a current debt. So so the entire amount isn't on their balance sheet. Rather, depending on the projection that they have for it as an accrued or carried cost, they might go out a few years in terms of booking it, but the full amount is not booked, generally not booked as a debt on the property. That helps property owners out, by the way, when they're thinking about dealing with refinancing, other kinds of credit that they're looking for, because it doesn't act the same way as say a mortgage would.
So do they own it then? If it doesn't show up on the balance sheet?
Own,
I'm just trying to figure out how, and I'm thinking about total value of the property, and if it's not showing up on the balance sheet because it's being paid through a tax assessment or an assessment.
well, I mean, the improvements show up. I mean, I would say we've seen some companies decide to declare the entire amount because of all the improvements that have been done. But we've seen others only carry the annual cost or a couple years cost on their balance sheet, and the rest is simply booked as just annual tax assessment projections for the lifetime of their property.
Thank you.
Any other questions?
It
is weird.
It is weird.
Thank you very much for
Thank you
your
very
time
much.
today. Really
Thank
appreciate
you.
it.
No problem at all.
Chris Delia is not able to make it upstairs. He is in Senate Finance. However, he said that I could read this text message on the record. He said it out loud in person earlier today, just. The Vermont Banking Association supports the bill as passed the Senate and worked on by the Energy and Digital Committee and the Commerce Committee. It's critical to the banks that the lender consent before property owner can take out a CPACE loan is in there, and that is in there. So thusly, is it a question for Chris Delia? Because I can't pull that off, Mark. Sorry, what did you want to say?
No, just, energy committee's vote was,
No idea, I'm sorry. But we can find
they have
out.
actual, they must.
Portia's gonna look it up, and next we're gonna hear, oh, sorry, Rick.
I'm sorry, Rick Sagal, Office of Legislative Counsel. They didn't vote on the bill. It went to Congress.
Oh, okay.
Oh, right, but just a drive-by with.
So let me rephrase. They had the bill number in their committee, but the language from that bill went to this economic development bill into Congress. So they took testimony, they spent time on it, but they never voted on the bill. To my knowledge.
Okay.
And Josh, do you wanna join us? Thank you for coming in on short notice.
Lifton.
For the record, Josh Hanford, Vermont League of Cities and Towns. Yeah, happy to speak high level about this bill. I've done that in several committees in the Senate and the House side. I start by saying we did not, the league did not work with the sponsor of this bill or at the request of our municipalities work to introduce this bill. This came at us, but we're happy to support it. We've had our municipal attorneys review it and feel that municipalities are adequately protected. Here, this is by choice, it's self-enacting. They have to vote to approve this. We're not sure how many municipalities will take advantage of this, but, for a few that have a very important business, that this is an option, we always support the authority for the municipalities to have a tool in the toolbox to use. And as I said, we feel, protected here. I think that, I've heard Chris D'Elia speak on this a number of times and, for any properties that have other lenders in them, they're going to have to sign off on this, because they'll be behind this new debt. So their support was really critical for us understanding and being comfortable. We also understand how a tax sale would work and how all this would play out if a business was to go sideways and had this PACE loan on the property. That's the difference. It's on the property. It doesn't stay with that business. So, that may give other lenders some hesitancy around this. It may work out with a type of property that has no debt. Maybe there's grant funding and financing. Maybe the grants can't pay for this level of energy efficiency or alternative energy added for, but they can approve a PACE program with the town and add that. And that could be stay with the property because it's a critical business or industry in that area that feel like it's going to be there forever and sort of need this support.
Is this solving a problem that you see the municipalities wanting to help solve?
In the sense that we want our businesses and institutions to remain successful and taxpayers in a town, yes. And if this is a part of that because, they want to reduce their electric rates or they want to prevent, other climate change issues from coming on board. I think that maybe this is just my theory. Maybe we're later to this because we've had such robust supports in the state, whether it's through Efficiency Vermont or other programs to help with some energy efficiency in these measures. And so this is newer for us, where some other states have had this for a while. I think if we look at the experience of the residential PACE, that I remember being around decade and a half ago when that was, all the rage and municipalities passing it at the request and at town meeting, but then we never really used it. I would argue because it was too complicated for the solution. There was $15,000, $20,000 loans through other sources that we made available to help weatherize homes and do that. And, maybe this is a gap for our larger institutions and businesses that could be helpful.
One piece of a capital stack.
Yeah, what?
One piece of a capital.
Exactly. I think one unanswered question that I've heard in testimonies, and we don't have a solution for it, is sort of an administrator. Like this won't probably work in a smaller community that doesn't feel like they have the capacity to take this on. In other states, there are sort of administrators that play this role, and maybe that can come later and we can figure out who's doing that. And so it's really, I'm not an attorney and I'm not a banker, so I can't answer those sort of questions. I can just say that We have reviewed it, our municipal attorneys have reviewed it. We feel that we're adequately protected and support having this new authority available to municipalities should they choose to use it.
Thanks, Josh.
Said that they book it by assigning future taxation, by putting on the spreadsheet that that's due as a tax in the future. But it's not a tax.
It's not a tax, and, you know, for example, the tax sale, if a property was to go to tax sale, the municipality would only be collecting the past due taxes. They wouldn't be seeking to collect this assessment. That's between the lender. You know, it's just a mechanism to spread it out over 20, 30 years and using this assessment authority that gives it a higher position, as I understand it, in the capital stack. It's the first position. That's why this could be beneficial, and it can be lower rates, and it could be spread over a longer time. Why, if you could get all those things just going to the market and to an lending institution, you would do that, not go through this. But you can't, is the fact these days. And so this,
Why doesn't it get listed as a payment still to be made like any other loan? Why is it listed as a tax?
because it doesn't go to, so let's say Representative Maslin has a business and he is approved for a commercial PACE, his community adopts it. That business that Representative Maslin has, this assessment is booked on that property, regardless of if Representative Maslin sells it or goes bankrupt or anything. It's not the obligation of Representative Maslin's business to pay this off. It stays with the property. That's the difference.
You're not answering my question. He's
Yeah.
listing it as a tax, a tax due, not a loan. That bothered me.
Yeah.
Because it doesn't sound right.
I wouldn't refer to it as a tax. I'd refer to it as an assessment on the property that stays with the property. It's just administered through the property tax collection system at the municipal level.
Wow, but were you here when he said tax? He said it's listed as a tax on the balance sheet in the, yes.
Or it's not on the balance sheet. So
Yes.
functionally, it sounds like you're not booking it as something you own. You probably can deduct it as an expense from your operating revenue. So it will reduce your tax liability in any given year, but it's not showing up on your balance sheet.
That's not what he said.
That
He
is what-
said it was listed as a tax on
As an
the
assessment.
long-term data that the town kept.
Oh, no.
Not the business.
Representative Brannigan, he was referring, the question that he was answering was how it was booked at the business's level, not at the municipal level.
So they probably count it as a tax, or deducted or expensive, but it's not showing up on their balance sheet.
The businesses, not the town.
Business's balance sheet, not the town.
Yeah, it's not an obligation for the town to collect this assessment if the business doesn't pay it.
It's
It's
between him
in the lender, yes.
whatever, the bank. So why doesn't it get listed that way?
Can't answer that.
That's what I'm asking. Oh,
Yeah. Is this a question for Josh?
It's an answer to Brannigan, I think.
Okay, so I just, anything else for Josh? Anything else from you? Oh, yeah.
Maybe, I'm not sure, Josh. Did you folks look in, I'm curious as to the capital provider.
Mhm.
They've been longstanding in the country and, are the FDIC
Yeah.
backed and all that? I mean, it's a question.
Yeah, I mean, again, Chris Delia might be better to answer that, or the folks that have testified that talked about to do this across the country. It could be Vermont lenders, there could be other folks that participate in this space. I think that the biggest security for the Vermont lenders is if they already have debt to the business, they get a veto.
Yeah.
They have to feel really comfortable. And maybe it's a small amount, that they have outstanding. And so they feel comfortable with this. It puts the business in a better position because the utility savings, that's a factor that they all need to weigh. Fortunately, the municipality doesn't have to do that type of assessment, understand it. They just have to assess whether this is something they want to offer and be involved in the sort of administrative process that this entails. And likely this will play out from an important employer that a town values saying, we really want this, we really need this, and that'll engage the discussion. I don't see this as one where municipalities are seeking to add this without that ask really coming from a valued employer. But if they do, we support the tool as long as we have the protections, which we feel we do in this bill. We're not obligated to pay. We don't have a risk if business goes out, any different than if the business didn't have a PACE assessment.
Thank you very much for coming in on the short notice. I appreciate it. And happy VLCT day.
Thank you.
That's it for the testimony I have lined up on CPACE. I'm gonna switch to veggie and an amendment for a moment. That's okay for folks? Okay. Rick?
Yep.
And I've heard from Ellen, that Ellen and Kirby in a conversation with maybe John Gray all agreed that it's likely that the education tax is with the municipal tax, but they're gonna draft some clarifying language to make sure that that's totally confirmed.
And could a school district, which is also a municipality, could that post this?
Oh, or error waste. I mean, there are lots of things that are municipalities, right?
Is it just a town? Could another municipality, like a fire district?
Rick, are you able to answer that question or?
So Rick Sabel with the Office of Legislative Counsel. I'm looking at the language, the legislative body of a town, city, or incorporated village.
Not a municipality, so great, thank you. So I asked Rick to draft some amendments. One is to, as Representative Kimball was mentioning yesterday about sort of the different levers available to us, rather than putting the sunset back in, bringing the thresholds of available for veggie down to the really where they've been spending the last few years. And then the second amendment is from Cam about pennies, to make sure that this is very clear that it applies to sort of everyone who's collecting money, not just private businesses, and we're still waiting on that amendment that I mentioned already about the education taxes.
I have the language from Kirby.
Oh, wow.
I haven't put it in.
Look at these split. Love it.
It's very,
Great. And how many
Very
attorneys
quick.
can we get on one bill that we are spending a very little
it's
bit?
almost the whole office at this point.
Great, I love it.
Okay, so shall I share the amendment? All right, so I'm gonna share my screen and show you all draft 1.5 of a proposed amendment. Most of these I actually talked about last time, but I would be bringing these to the committee's attention, and I'll talk about those. But we will start with the veggie amendment. In the House Commerce version of the bill that was reported out favorably, the sunset is removed, so veggie would live on. My understanding, that's a debate here as to whether it should be the sunset is removed or if you should push back the sunset. So I currently have that as a option if you want to consider it. Otherwise, you can go with the House Commerce decision
I
too.
think that what we were imagining for this amendment is that we would leave the removal of we would remove the removal.
Repeal the sunset.
Thank
Sure.
you.
Yep.
Repeal the sunset,
Sunset the
align
sunset.
with commerce, yes, but reduce the
Yeah.
threshold.
Okay, so I'm going to strike out this amendment. So we'll have a draft 1.6, which is fine. It'll be another amendment.
Let's get to 1.10.
No. And we were driving the double digits at that point, I make it two. All right, so in the second instance, which will become the first, you have the veggie annual program cap. And current law, VEPSI, when they are considering veggie applications, they're able to approve up to 15 million for one or more initial approvals. But then the actual annual cap is 10 million. And there's some math, Pat Fitterton might be able to explain the initial approval versus the final approval, but 10 million is the kind of annual cap that they actually can approve for applications. They're also allowed to go up to 15 million currently. Subsection B, they can go 5 million higher. So with this language, the annual cap goes down to 5. However, they could increase the cap to 10 with joint fiscal committee's approval. That is the amount for this veggie cap.
And we can hear from Pat about where how much money they've spent in the past, and if this will change anyone's lives. Yes.
And well, no, I just want
Yeah.
to interject that, I'm not that familiar with the program. So I just want to make sure that the Commerce Committee has considered this and say thumbs up.
The Commerce Committee has, or at least the leadership of the Commerce Committee has thumbs up, but they would, of course, hear our amendment and vote on it.
Okay, thanks.
I shared with the committee by email yesterday, the annual awards that were realized over the past 5 years. So that you should have that in your inbox somewhere.
And Saoirse, can you post that?
Yes, I saw that.
Sure. The email that Charlie sent yesterday. Thank you. Great.
Moving on to the third instance. So this is the rural industry development grant program. You may remember that discussion yesterday. So this first paragraph here is.
Sorry, before you say it, this is language that Chair Marcotte asked us to put in.
Yes. And also to me to clarify, because it was very quick work 2 days ago, getting this bill complete. So nothing crazy is happening here. The first paragraph, we're moving the grant program session along the statute. I explained that yesterday. So that first paragraph is saying, just because we're doing this doesn't mean those previous awards are null. You still have your award is still active. But also clarifying, again, this is through the chair of the committee and through ACCB, that if an applicant who already had an award through the previous program has not had their application fully paid out, their award fully paid out, they can get a higher reimbursement rate. Their total award has not changed. So if they're awarded $500,000, let's say, and let's say they've gotten half of that so far, $250,000. When they submit their expenses to ACCD, those expenses can be paid back at 50% instead of 20%. That's currently. I didn't know how it worked. That's ACCD told me this is how they reimburse the grantees is by an expense reimbursement process. So again, the award total is not changing. It's just how quickly they can get reimbursed for their expenses. And once they hit that 500,000, whatever the award is, that's it. They're not going to get more money. And 3 makes that clear that you're not going to get more money. That's it. Any questions about that?
That's for the existing ones that are already,
Yep.
that's all we're dealing with.
Yep, in this paragraph. So the underlying bill has the new program and there's different provisions, but this is for the previous awardees. Okay. The fourth instance, this is just a technical update. I did not put in the phrase section 13B. This is the nickel rounding, just adding in the purpose of this section, not the entire act, is X, whatever the purpose statement is. So just a text correction. The fifth instance of amendment is a bit more substantive. I may allow my colleague Cameron Wood, who drafted the underlying bill, discuss this change if he would like, and if you would like that, Chair.
For the record, Cameron Wood, Office of Legislative Counsel. There was a question that was asked, the sub B here, which is really the operative section in this piece of the bill, where it said a person or business engaged in a cash transaction may round the final amount due. And one of the questions was, would this be applicable to the state if the state wanted to be engaged, if the state was engaging in a cash transaction? So we went back and double checked, and person is defined in statute. It's in 1 VSA 128, and it does include natural persons, corporations. It includes the state. It includes municipalities, political subdivisions of the state, etc. So because the word person is kind of all encompassing there, it felt a little redundant to say a person or a business engaged in a cash transaction, given that a person would also include a business. And so the amendment here simply removes the word or business. So just a person engaged in a cash transaction, That's gonna include naturalized people, corporations, in the state of Vermont, if the state were to choose to round. So that's the two amendments in that instance are in the one, the B1 and the B2, just to remove or business.
How's this, yes, a question. How's this work with the word may? Let's say I'm trying to buy something from Carolyn. I'm the business, Carolyn's trying to buy it from me. And she wants to round and I don't, or vice versa.
Right.
I want to round and she doesn't. How do we decide?
There's nothing in the statutory section that mandates rounding. So if you as a business are accepting cash, you can require that the individual provide you, you can exchange in the exact amount that's due, and you can provide exact change if you so choose. So it's really the business that would be making the determination of whether rounding is going to occur. And this allows the business to round the transaction to the nearest 5. So it's not a mandate, but if a business engages, if they're wanting to round their cash transactions, they would have to do it in this way. Or I should say it slightly differently, they would run the risk of engaging in some sort of deceptive practice if they don't round as it's articulated in the statutory section. So
Asking Kelly, did we verify whether you can make this specific to just cash? Like what if they then pull out their credit card?
right. So the section is only applicable to a cash transaction. And there's nothing that I'm aware of that creates some sort of legal problem by limiting it to just cash and not electronic transactions.
And you've done research on this because I
Yes.
asked you that question 5 times.
Yes, ma'am.
Yes.
And so what you've seen in the other states that have both passed legislation, the National Conference of State Legislatures, recommendations around this, even at the federal level, that they're all limited to cash transactions and not electronic transactions.
And there is NCSL sort of guided model.
I just
Legislation.
wanted to verify the question you asked.
Yes.
Yes.
Any other questions about the penny? Great. If I accomplished anything this year, it will be that.
So one more section in the penny bill, just kind of more technical changes during the House Commerce bill movement. We were stripping out language that probably should not have been stripped out. So this is in the notice where the person must provide notice that they round. The commissioner prepares, and this is language that was in the House Commerce version. They provide this model notice pursuant to the section, and that shall also include a reference. That phrase was not in the underlying bill. And then subdivision 2, a person, it was a person or business, so correcting that to a person. And then in a clear and conspicuous manner at the point of sale or the entrance to the business. That was in the bill, did not make it into the House Commerce version. That was a oversight on my part, and I would suggest you could not include that, but otherwise we're giving some kind of guidance of where the notice should be posted. I think is recommended, but it's up to you all how you feel about that.
This is just inquiry as far as, do we generally say it shall be available for free and not or available at no cost?
Oh,
I'm just curious as far as other legislation. So I've seen it that much.
Yeah, I don't recall off the top of my head, it's not gonna have any substantive change or impact, obviously, if you say for free or at no cost.
and the editors didn't flag it.
They did not flag it for change. So.
Fine, thanks.
My one question about the clear and conspicuous, which I think makes a lot of sense now, is that in 10 years, it might look absurd. And so I wonder if there's a way to have it not be in statute and be somewhere else so it could be changed more easily in the future. So that there aren't just like dusty, decrepit signs on counters in 10 years when there are no pennies.
One thing I would just comment is this was in the underlying bill to require there be some sort of notification to individuals that a business is choosing to round their cash transactions. Clear and conspicuous is the kind of standard
Yeah.
language that's used in the consumer protection space, so I would advise you, keeping that. And then this says just at the point of sale or entrance to the business. I don't think there's anything that would prohibit a business from trying to keep their point of sale clean. We would all recommend them do that.
Okay,
But.
Great.
Madam Chair,
Okay.
it's up to you. You
no,
could
no,
just
it's
say
fine.
that.
I've really overthought this already. I'm gonna stop now, overthinking
And you
it.
can change it in a year or two. if you-
I definitely won't.
You should
Yeah.
add in a repeal for this.
Reversal.
Rick.
325 reversal. Capital Plaza.
Okay, we're gonna finish our bill. Thank you.
What's that?
Is that for you?
I-
Representative Page, are you late for something?
No, I apologize.
It's fine. It was fun.
For my colleague.
That's not yours to do, sir. Okay. So any other questions for Rick on this?
So only,
Yes.
we had a brief discussion of why so many agencies.
Yeah. On the nickel. on the-
Yeah, why liquor and lottery, why agency of?
Yeah, so I can talk about the Agency of Agriculture here because the Agency of Agriculture is the entity that goes in and enforces weights and measures. And so the agency goes into business establishments, and part of what they will do is they will scan, and check the price, that's on the shelf, and then make sure that when the individual is at checkout, those prices match each other. And so the committee felt that if you're going to require this notice, then the agency would be at the point of sale, checking the rounding. If a business is going to be rounding, they're going to have to explain to the agency at that point in time. And so it probably makes the most sense for that agency to be the one to say, if you're requiring a notice, if you're going to round, then the agency could say, okay, show us your notice. And they would be able to enforce most effectively for that piece. As far as Department of Liquor and Lottery, I will defer to the chair of the Commerce Committee. I believe he said that he had spoke with them and they were willing to create the model notice.
I also spoke with them today, so I will speak for myself, so you don't have to speak for Chair
Sure, that's
Marcotte.
fine.
And they were already sort of moving forward with guidance about this because they essentially, they collect the most cash of any state agency that collects cash at liquor stores, right? And so they're already working with so many of their stores to provide guidance on this. And so they're very comfortable with this. Okay,
I have just one more amendment, which is a fun one.
yes.
I'm trying to get this bill to have the most deleted sections. That's my goal. And this is adding 4 new sections that are deleted because when I drafted the amendment in House Commerce, I created a 10A, a 12A, 13A, and 14A, but not the underlying 10, 12s. Anyway, for drafting purposes, it does not matter. For lawmaking purposes, but for drafting purposes, it should have been 10, 10A, 10B, and not 10A, 10B, 10C. So I'm doing this to make sure it all looks appropriate.
Cool.
Yeah,
Thank you, Rick.
quick work. And then I can address the amendment, the CPACE language. Madam Chair, if you give me 10 minutes.
Yeah, that would be great. And I think we can hear from Pat on where the veggie stuff has been and will be.
What's that?
CPACE language or changes.
Rick and Cam, I have a surfeit of text messages about the use of the word free. Can you change that?
No cost.
Thank you.
Great.
Pat, the floor is yours.
Sure. Joining the Zoom, I guess I haven't seen exactly what Brett Marcotte, or sorry, Kimball, distributed to the committee, but what I just have pulled up on my screen, the annual report on the veggie program. Rick seems to still be sharing his screen.
Oh, sorry. See my work here.
I'm seeing it in live time.
Okay.
everyone can see that. Yeah, so this is just a page from the Veggie annual report. It's their most recent one. Annual program caps. So it's showing three things, going back to 2007. So it lists the program cap for that year, the final approvals, so the number, like the amount that was actually awarded in that year, and then lastly, the net cap balance, the amount they could have still awarded if needed. So I guess we'll go starting 10 years back, let's say. You can see that the program cap in that year was 10 million as it is statutorily. And the final approvals came out to 4.6 million. So in every year in here, they have been below that $10 million cap in terms of final approvals. But, if you were to shift that, it's currently 10, go down to 5, but with the supplemental 5 able to be approved by that JFC, you can see that there are a few years in here that they would have had to come and get that approval. 2019 being one, 2021 being another, 2022 being another. But you can see that since, going back 10 years, their final approval amounts have been below what their now supplemental, like if you added the supplemental 5 million would be. So, the one piece that is not included in this, and I don't know if this is something that they would look for, I'm just not the expert, is it doesn't include the initial approvals. So, starting the process, but maybe towards the end, it doesn't actually end up getting approved, but allows them to, consider the application anyway to start. So that's just something I'm not aware of, because it's not included in the report. And I actually haven't reached out to them for clarity on that personally, but when thinking about final approvals, what you have drafted, what Rick has drafted for you, their final approval amounts in many years would not hit the 5 million amount, but in the years when they would need to ask for supplemental, that supplemental cap, it still fits under what you have drafted at the 10 million total with the supplement that JFC can approve.
Question, I guess, for either both, if we lower the cap and for some reason with a supplemental, they need to ask for the supplement, would it be the joint fiscal committee that would?
Yeah, that's in the statute. And that's how we've had it set up for a while.
Just for, clarification.
I don't remember that.
Understood. Thank you.
And since I've been here, I believe there has just been 1 year that I've been here that they've come for the labor market enhancement
Yes.
supplemental amount.
Yeah.
But I don't recall them requesting the 5 million that they currently
Got
have,
it. Thank
can
you.
have approved. Yeah.
Thanks. Any other questions for Pat? Great.
The trade-off is you would remove the sunset. Theoretically.
Yes. And I think Rick had did that in real time while we were watching. So I think we're gonna vote tomorrow morning, unless you just finished.
If you give me, I need 5 minutes. See, Grace.
Folks okay with 5 minutes?
Madam Chair, is it possible to separate that PACE sections, self-paced sections out of the bill? Vote on that separately and then the rest of the bill.
Are you formally requesting a division,
Yes.
Representative Brannigan?
Yes.
I think so. Let's do that in the morning. Let's do that in the morning. Let's all sleep on C-PACE. Okay, so thank you, Rick.
Yep.
Are folks gonna need Rick to take us through the amendments tomorrow? Or can we do it without Rick?
You do a fabric, I would prefer to like take the time.
Yes, agreed.
Just I keep
Okay.
rushing you guys because it's hard enough complicated.
Okay, so we are going to vote on this tomorrow morning. It's going to be so fun and I'll see you all then.
And Carolyn, I have a,